Are you wondering how close you are to financial independence, that magical time when you can retire and not do work that you don't want to do anymore? In this video, that's what we'll be doing. We're doing the money challenge for this month is seeing how close you are to financial independence. This is video number 3 in that series. If you haven't seen video number 1, where I explain about living off your investments versus living on your investments, you can go watch that video for an overview of what we're doing here. You can grab your handout at retirecertain.com/gap, GAP, and subscribe to my channel here so you see each of the videos where I step you through each row that you're going to fill in on this handout. Now, in this video, we're going to talk about row number 2. Last time we talked about liquid investments, and you put the total amount you have in liquid investments in row 1. Row 2, we're going to put in expected yield. And this is a really big topic. I'll keep it short though. I promise to take this step by step and not go on too much about it. So expected yield is tricky. Now, we're not talking about return. We're not talking about the total return, for example, that you get from the S&P 500 over very long periods of time, over decades, close to that 10% amount. That, again, includes growth, it includes dividends, and it includes the compounding of that growth and dividends. What we're talking about here is income only. That would be something like dividend income from stocks, interest income from bonds. It might be REIT income, that's real estate investment trust. It's a fairly common income vehicle for people seeking income from their investments. Another one is MLPs, master limited partnerships. That's oil related. So we're looking at what kind of yield you can get off of that. Money market yield is another example. Let me throw out some amounts so that you have sort of an idea of how much yield various investments, income generating investments are yielding as of the time I make this video. As you know already, we've been at really low interest rates for a really long time, and that's one of the reasons that I was driven to start here with living off investments versus living on investments, because it's hard to generate income from traditional and quality stocks and bonds these days, and it has been for quite some time, making it challenging for retirees and people that want to retire. So yields on the S&P 500 stock index, as I record this, for example, are just under 2%. They've been around 2% for a really long time. Another example is money market. Right now it's a little over 2%. Vanguard Prime money market got as high as around 2.5% not too long ago, but it's a little down now that interest rates have been cut. By the time you watch this, maybe they've been, come up a little bit, but somewhere around 2% for money market, maybe a little bit over. And because we have been playing with an inverted yield curve, sort of tinkering around that for some time, those long-term bonds also have a yield that's just really not that great, around 2%, maybe 2.5%, not much higher than we can get from our money market accounts. And so yields on all of those things are very low now. Some other things that have higher yields, and I've talked about this some more here and written about it at retirecertain.com, is, that reminds me, I forgot to tell you who I am. I'm Camille Gaines, and I have been investing for almost 40 years. I don't manage wealth for other people. I just like to invest. I like money, talking about money. I write about money. It just interests me. It always has. And that's who I am. I write at retirecertain.com. And so let me carry on with that. There are other investments that are yielding higher, of course, than those lower yielding investments like money market and the S&P 500 index. And let me throw out some examples. Some higher yielding stock dividends, for example, might be in the 6% range. AT&T, for example, is still around 6%. I think it's a little bit over 6% as of now. So that's a perfect example just to give you an idea quality-wise of what is yielding, around 6% from a stock standpoint. There are a number of other decent quality stocks that are yielding in the 4 to 5, 6% range. And then, of course, there are higher risk stocks and there are funds that have a higher yield. Now, going on up 7, 8%. Most of the funds you're going to see, though, are lower yielding funds, maybe 3.5%, maybe 4%, but really in checking lately for an article I was doing for my website, I was seeing around 3.5%, even for funds that are, supposedly income focused, dividend focused, right? So, yeah, you can get higher than that 3 or 4%. But it may involve you constructing your own portfolio or perhaps a wealth manager or financial advisor that chooses stocks that are higher yielding, or other funds that are a little bit higher risk that have more of a focus on higher dividend. So that's an example of that. REITs are, yielding everywhere from 2 or 3% on up to, 10% and maybe higher. The sector as a whole has gone through some doubt and some turmoil with Amazon, and that's related to the retail sector in the REIT industry because of online shopping, of course. So there's a lot going on there, but certainly higher dividend yields or higher yields than the S&P 500. And then, of course, there are also MLPs that have high yields that are similar to the yields that I said for the REITs, 2% up to 10, 12%, and even higher in the MLP industry. Now, those are examples of what you can get. The big question of what to put here for yield is how much yield do you think you can get? And that's sort of a factor, partially a factor of how much risk you want in your portfolio. As a general rule, the higher the risk, the higher the yield, the higher the risk. That's not always the case, though. For example, in March of 2009, we had the exact same stocks that were trading, twice as much 2 years earlier, and it was basically the same company, even though we were in a recession and perhaps sales were down a bit as far as the debt structure and that type of thing. Overall risk wasn't hugely different. And because the market had corrected, those stocks were cheap following the bear market. So sometimes you can buy quality assets that have a higher yield, and that's something to consider. So it's not just the price that's that you're currently hearing for the yield, or the amount, I should say, that you're currently hearing. It's also, yield is a factor of the price you pay for an asset. When you purchase assets that are at the higher end of the valuation, you're going to get a lower yield. And when you purchase assets that are cheap relative to the payout, you're going to get a higher yield. So once again, I really, really like to point out that we're always in those economic cycles. And I say always because it's not like it changes every year or every 2 years even, long economic cycles, and that affects our investments and the amount of yield we can get, and also the amount of growth we can have from our investments, because the growth is a function of the economy. So for yield here, I would suggest that you look and see what kind of yield you're getting right now off of your investments. And it's a good exercise to do anyway. So look and see what on your statement or on your online platform, you could look and see what you got for your most recent statement, or you could check with the company that you've invested with to find out what it's yielding right now. A lot of times I just Google, if I have a fund, I'll just Google and see what it's yielding right now. ETF, anything like that. It's really super easy to check and see what it's yielding right now, on a daily basis. So look and see what you're getting right now. And that's what I would put right here, because what we're doing is looking to see with what you're doing right now and where you are, how close you are to financial independence. And down here later, we can talk about ways to increase this perhaps. But for now, look at where you are and what kind of yield you're getting, so we can use this as the foundational piece. Again, you can grab the handout at retirecertain.com/gap. I'll put a link below the video. Make sure you subscribe so you see the videos in the entire series. They'll all be here, right here on YouTube, so it's easy for you to watch them. And I appreciate you watching this video. Thanks.